How do you get banks to lend more to the real economy? The PBoC's Deputy Governor Peng Gongsheng said China will broaden the investor base for commercial banks' perpetual bond issuance. Perpetual bonds, or PERBs, refer to debt without maturity dates. They help recapitalize banks with inadequate capital to lend.
China would allow qualified long-term investors, such as mutual funds, as well as high-net-worth individual investors, to invest in such bonds. The PBoC doesn't have any quantitative target on the issuance of perpetual bonds.
In January, Bank of China became the first Chinese lender to issue such bonds, taking advantage of the low-yield environment. It was popular as insurers, brokerages, and offshore institutions subscribed for those bonds. PERBs could potentially convert the debt into equity. That's a selling point of such debt. And the PBoC now allows PERBs to be swapped for central bank bills. That's aimed at increasing the liquidity of perpetual debt, driving up interest, and potentially lowering the issuing cost. Deputy Governor Peng Gongsheng says the central bank bill swap practice is not a de facto China QE and will not have a huge impact on the liquidity condition in the Chinese banking system. However, one official from the banking and insurance regulator says Chinese commercial banks still don't have enough capital.
Chinese banks' capital adequacy ratio was 14.02% at end of 2018, up 0.55 percentage points from a year earlier, while their Tier 1 capital adequacy ratio rose 0.24 percentage points on the year to 11.58% at the end of 2018. That's only higher than the lowest acceptable level in the global market.
CIB research estimates Chinese lenders need to raise 470 billion yuan this year to cover a shortfall in Tier 1 capital. More PERB debt sales are expected, but analysts warn that the funds raised should be going to efficiently allocated projects rather than create more over-investment issues. Xia Cheng, CGTN, Beijing.